Hey there, my name is Michael Blanc. If you want to learn more about getting started with apartment building investing, you are in the right place. In today's episode, we're going to talk about determining what yields the maximum profit, whether I should sell in 3 years, 5 years, or should I refinance and hold. And that's what we're going to talk about today. So how do you determine when to sell your apartment building, or whether you should sell it all and maybe just hold it or refinance? Right? I'm going through some of this decision-making process right now for one of my buildings, and I want to share with you my thinking. So as always, there are multiple factors that go into deciding what you should do. For example, have I created most or all the value there is to create, or is there some additional upside? How attractive is the future cash on cash return, and how does that jibe with my investment criteria? What do I expect the markets to do? Are we cresting? Are we bottoming out? What yields a higher return, right? So, and that's kind of what we're trying to do here is selling, holding, or refinancing. So let's apply these criteria to a particular case study. Okay, so I'm going to show you in a second a 20-unit building, and it's a stable value add deal. It's a 20-unit building, and the rents are $150 under market because of some deferred maintenance and cosmetic upgrades. It's going to require about $2,500 worth of work, and we're projecting a $100 increase in rents over the next 3 years. So very boring, base hit thing that's going to make us a lot of money. Okay, but now the question is, well, what's going to be more profitable of those three scenarios? So selling in year 3 or 5, refinancing and holding, or just holding for 10 years. So in order to answer these questions, we're going to have to now look at something called the internal rate of return, or IRR. And the reason I normally don't talk about the IRR because it's an advanced concept. And when you speak to, for example, investors about IRR, they just confused, and a confused mind says no. So I don't talk about the IRR. IRR is for more sophisticated people, and it takes into consideration the inflows and outflows of capital as well as the passing of time. And in the case of a refinance, there actually is all three of those. There's an inflow of capital and then an outflow. So investors put a bunch of money in, and then after some time, the money flows out again, but then there's cash flow before and after. And time passes, right? So the only way to compare apples to apples is by using the IRR. So we're gonna talk about that here next. So in order to demonstrate the IRR, I'm going to use a financial model that I have called a syndicated deal analyzer. Now you don't need to have this. I'm just using it to show you the concept of IRR and the overall return. If you want it for yourself, you can just Google syndicated deal analyzer, and you can find it that way if you want to use it for evaluating your own deals. But you don't need to. So I'm just going to show you what this means in this scenario. So let me introduce the deal. It's a 20-unit deal. Asking price was 1.1. We have it on contract for $877, and there's some work we need, about $2,500 per unit in work. All right, so here are the income and expenses. And what we're doing is, in the projection, we're modeling an upside in rents from currently $600 to $712, so about a $100 increase over the course of 3 years, and that's kind of the upside. Now, right now we're modeling a sale in year 5, and for that we're getting a 15.79% average annual return. And the IRR is 13.449. So it's these two things, and they seem to say the same thing, but they're kind of different. Now, the average annual return, like I said, is normally easier to understand. Average annual return means that every year, if I put $100,000 in, I expect to get about $15,000 out of it over the course of the 5-year hold. Very easy to understand. Now, the IRR is a very complex formula that accommodates inflows and outflows of capital as well as the passing of time. For example, $100 now is worth more than $100, say, 5 years from now, right? So there's this passing of time that devalues the money because of it. And that's what the IRR does. Now, because we're going to try to compare refinance versus different selling situations, we have investor capital flowing in here, $350,000 to close on this deal, and then when we refinance, we have it flowing out again, and maybe not all of it, maybe part of it, and then there's still cash flows before and after refinance. So the IRR is the only formula that accommodates this. So in order to compare one versus the other, we need to really look at the IRR. So in this scenario, we're selling in year 5. So we want to compare selling in year 5 to, for example, selling in year 10 or refinancing in probably after year 3. And the reason we're picking year 3 is because we have stabilized. If we go back to the P&L, you see here we're going from 600 to 712 over 3 years. And then we want to see what if we refinance at the end of this year where we built all our value, and then we'll just hold it. So we will always look back at the IRR to compare that. Now, just so you see what the IRR is made up, you can create this in Excel as well. This is a very simple table here that you can create in Excel, and you see the formula here is IRR, and then a sequence of cash flows in and out, and then Excel calculates the IRR for you. So you see here that the cash flow, the member contribution, is a negative number that starts in year 0, and then these are the cash flows in each of those years. This is where the sale is, for example. You see the proceeds from the sale here? That includes the return of the capital, so this is why this number is so big. And so the total here, the total is on the bottom, and then the IRR takes into consideration each of the years. So that's how you set up an IRR table. So fairly easy to do, and so that's kind of how it works. So with that background on IRR, let's kind of compare one strategy with the next. So like I said, first strategy is an exit strategies. We're selling at the end of year 5, and we have an IRR of 13.4 now. Now let's see what happens if we try to sell this in year 10. So year 10, let's go to our summary, and the IRR actually went up just slightly, but it's basically stayed the same. I mean, it's basically stayed the same. All right, I made some chicken scratch here on the right here to keep us straight here. So 10-year hold, the return goes up a little bit, but it's essentially the same. So let's see what happens if I refinance at the end of year 3 and then hold for another 7 years. So you see here now the IRR went up to 17.33%. So it went up. Why? Because when we refinance, we pull out a bunch of equity and return it to investors. And so therefore our cash flow or return is divided by a smaller number, which is why the return goes up. This is why a refinance is a very, very, very good strategy. And now let's compare this to refinancing and say at the end of year 5, just for grins, and see what happens there. It goes to 16. It goes down just a little bit. Now we can continue this process just to kind of see where the maximum. You'll see that this is going to start. It's going to start dropping off, right? So we're not really getting a lot more. We seem to get. Let's do year. Let's just do year 2. Let's do at the end of year 2. Let's see here. Year 2 is 15.37%. So this is year 2. So really, it appears on looking at this that the maximum IRR we're going to achieve is right at the end of year 3, and this makes a lot of sense because we've built all the value. So to get this giant curve of value building, and it kind of peaks right at the end of year 3, and then it kind of levels off. So this observation with regards to return makes a lot of sense. So this is why my favorite strategy really is a value add, refinance, and hold. So deciding to sell a building is never easy, especially if you've grown accustomed to the cash flow. It also depends a little bit kind of what kind of lifestyle you want, right? So we just looked at the numbers where the IRR was the highest when we refinanced in 3 after we built all the value. And really, if you do that on a continuous basis, you can really maximize your return. You're constantly adding value. As soon as you've maximized value, you refinance, you pull cash out, you do it again, you can grow a business massively in this way. But on the other hand, you're also constantly working, right? You could just say, look, why don't I just let it ride? I don't want to do all this stuff. I don't have to squeeze out every penny out of a deal. But the decision's up to you. Right? It's a great thing. You can make more money or less money. It really depends on what you want, what your lifestyle is to be. But this is basically how you evaluate whether it's better to sell year 3, 5, 10, or do a refinance and hold. So hope you enjoyed that. Found it useful. If you're interested in finding out more about apartment building investing, make sure you go to my website, themichaelblanc.com. And especially if you're interested in analyzing deals, more information about that, there's an ebook I have all about the 10-minute offer and analyzing deals, and that's at themichaelblanc.com/analyzer. So THE Michael BLANK /analyzer, and you get to the ebook download page for that one. All right, guys, appreciate it. Thanks for your time and attention. I'll catch you next time. Hey, thanks so much for sticking around to the end of the video. I want to leave you with 3 next things to do. I'll give you a quick tour of those, and I'll tell you how to do them. Step number 1 is to download my free ebook, The Secret to Raising Money to Buy Your First Apartment Building Deal. It is an awesome ebook full of tips for raising money and how to do that. So that's number 1. Number 2 is to subscribe to my YouTube channel because I put out new videos all the time, and I'd hate for you to miss it. And number 3 is to watch the next video in line. All right, so what you're going to do is you're going to click on the first thing, which is to download the ebook. That'll open up a new tab. The video will stop playing. You're going to get the ebook, and then go back to this video, and then click on number 2, right, which is to subscribe on the channel. That'll open a new tab, and then you can go back to the third one and just click on the next video in line. All right, so hope you find that helpful, and I'll see you in the next video.